If you are filing ITR-4 this year, stop. Before you click that submit button, you need to know something. The Income Tax Department has just released a document with 411 specific rules, and if your return breaks even one of them, it can get rejected. Your software can be blacklisted, or worse, you will get a defective notice under Section 139, subsection 9. I read all 24 pages, so you don't have to. In the next 10 minutes, I will show you the top traps everyone falls into, the rules that nobody talks about, and the exact mistakes that will get your return thrown out. Stick with me till the end. There's one rule about cash donations above 2000 rupees that 90% SSCs miss. So, what are we actually talking about? On 15th May 2026, the CBDT, Central Board of Direct Taxes, quietly released a document called ITR-4 Validation Rules for Assessment Year 26-27, version 1.0. This is the rulebook that the income tax e-filing portal uses to check your return the moment you upload it. These aren't suggestions, these are automated checks. If your data breaks a rule, one of three things happen. Category A, your return won't even be allowed to upload, rejected on the spot. Category B, it uploads, but you get a defective notice under section 139 subsection 1 9 from CPC. Category D, it uploads, but your deductions get disallowed. And here's the kicker. If you are using third-party software and that software keeps breaking these rules, CBDT can blacklist it without notice. ITR-4, also called SUGAM, is for you if you are a small business owner using presumptive taxation under Section 44 AD. You are a professional like doctor, lawyer, CA, freelancer, consultant under Section 44 ADA. You run a goods carriage business under Section 44 AE. Your total income is up to 50 lakhs. If that's you, this video is mandatory. Let's go into the traps. Trap 1, the presumptive income. Percentage game. This is where most people slip up. Under Section 44 AD, you declare a percentage of your turnover as income. But the percentage depends on how you receive the money. Receipts through account pay check, bank draft, or electronic modes. Minimum 6% of the turnover should be your income. Receipts in any other mode, example, cash. Minimum 8% of the turnover to be your income. The portal will calculate this automatically. If you declare even rupee 1 less, the return won't upload. And here's where people get caught. The new turnover limit is 3 crores for 44 AD. If your turnover crosses 3 crores, you can't file ITR-4 at all. You have to go for ITR-3 with a tax audit. And next, for 44 ADA professionals like doctors, freelancers, consultants, your presumptive income must be at least 50% of the gross receipts. And the limit is 75 lakhs. If your cash receipts are within 5%, cross that, tax audit is mandatory. For 44 AE goods carriage, minimum 1000 per metric ton per month per vehicle, about 12 metric tons, or 7500 per month for smaller ones. Declare as less, return rejected. Rule of thumb, never under declare present income to save tax. The system catches it instantly. Going to the trap 2, the old versus the new regime landmine. This is the biggest source of confusion this year. The new tax regime is now default. If you don't actively opt for the old regime, you are automatically in the new one. And the new regime disallows almost everything. Under the new regime, you can't claim Section 80C, that famous 1.5 lakh deduction, 80D, medical insurance, 80G, donations. These all you can't claim. Section 80TTA or 80TTB for interest income, Section 80DD, 80DDB, 80U For a disabled persons, 80 EE, EEA, EEB, HRA exemption and under 1013A, LTA under section 10 subsection 5, you can claim. What you can still claim in the new regime? The standard deduction is 75,000 rupees for salaried persons, which is up from 50,000, and section 80 CCD subsection 2, employers NPS contribution up to 14% of salary, and also 80 CCH for Agniveer Corpus Fund. These are available in the new regime. The catch: if you want the old regime, you must file Form 10 IEA within the due date. Miss the deadline, miss the regime. And once you have opted out of a new regime and come back, you have limited chance to switch again. Coming to trap number 3, the 2000 rupees cash donation rule. This is the big one. This is one I promised at the start. Pay attention. If you are claiming section 80G donation deduction under the old regime, here is the trap. If your cash donation to the same PAN exceeds 2000 rupees, either as a single entry or as a multiple entries added together, your eligible deduction becomes zero, not reduced, zero. And one more, in the schedule 80G, the same donee PAN can't appear more than once. Made multiple donations to the same NGO, you have to combine them into one entry. Also, new, for donations in any mode other than cash, you must now provide the IFSC code and the transaction reference number, UPI ID, check number, NEFT, RTGS, IMPS, everything. This rule alone will catch thousands of people this year. If you donate, donate digitally. Period. That's all. Coming to trap number 4, the TDS mismatch killer. Here's another deadly one. If you claim TDS credit in your return but don't show the corresponding income, category A defect, return won't upload at all. The system checks total TDS claimed is equal to sum of TDS 1 plus TDS 2 1 plus TDS 2 2. Income offered for the TDS greater than or equal to TDS amount claimed. Section codes match the income type. For example, section 192 is only for salary. If you put it under income other than salary, return gets rejected. And listen carefully. If your TDS section is 194B, BB, BA, IA, IC, LA or S, these are special rate incomes like winnings, property sale, virtual asset. If TDS deducted under these sections, you can't file ITR-4. You have to file ITR-2 or ITR-3. Always download your AIS and Form 26 AS before filing and reconcile every single TDS entry. Come to trap 5, the house property mistakes. If you have rental income or a home loan, watch this. 1. Standard deduction on house property is exactly 30% of annual value, not 29%, not 31% or actual amount. The portal does the mathematics. 2. If your property is self-occupied, you can't claim municipal taxes paid. That fee must be 0. 3. Under the new regime, if it's self-occupied, you can't claim interest on borrowed capital. This 2 lakh deduction is gone. 4. For co-owned property, the SSC's share plus co-owner's share must equal 100%. And your PAN and co-owner's PAN can't be the same. 5. If you have selected let out but gross rent is 0, return is rejected. Either show rent or change the property type. Trap 6, the 80D medical insurance traps. If you are claiming 80D under the old regime, self and family max 25,000 rupees, self and family with senior citizen max 50,000 rupees, parents maximum 25,000 rupees, parents senior citizen maximum 50,000 rupees, preventive health checkup maximum 5,000. This is inside the above mentioned limits, not extra. Total maximum across all categories can't exceed rupees 1 lakh of rupees. Now, new requirements this year, you must enter insurer name, policy number and receipt number. No more vague 25,000 medical insurance specifics or no deduction. Trap 7, the small details that will haunt you. quick fire round we will go through. These small rules trip up thousands. Aadhaar must be linked to PAN. Otherwise, consequences under Circular 3 of 2003 kick in. Name in return must match a PAN database exactly. Even one letter wrong is equal to category A rejection. Mobile number, email, secondary address, all mandatory. Rebate under section 87A, old regime is up to rupees 12,500 if income is less than or equal to 5 lakhs. New regime up to 60,000 if income is less than or equal to 12 lakhs subject to marginal relief. Agricultural income shown as exempt can't exceed 5,000 rupees. Anything more than that, file ITR-2. Due date is 31st August 2026 for non-audit cases unless extended. HUFs and firms can't claim ATC, CCD, EE, EE, AE, EB, UDD, HRA, and many others. Check eligibility first. Practical checklist before you file. Before you hit the submit, run through this 5-point checklist. Reconcile AS, Form 26AS, and TDS certificates. Every single rupee. Decide your tax regime and file Form 10 IEA if choosing old regime. Check turnover limits 3 crores for 44 AD, 75 lakhs for 44 ADA. Donate digitally, never cash about 2000 rupees. Verify name, Aadhaar, PAN, contact details match the official records. There are 397 more rules in this document I didn't cover today. If you want me to do a part 2 with a deep technical rules, schedule BP, schedule 80 GGC, form 10 IEA scenarios, comment part 2 below. And if this video saved you from even one mistake, smash that like button, subscribe and share it with anyone filing ITR-4 this year. Don't wait for a defect notice under 139.9. File it right the first time. See you in the next one.